Okay, so thank you, and it's a great pleasure to be here, and thank you, Matteo, for your introduction, but thank you, Ante and Hanfa. This is a great, not only for the great hospitality, everything is perfect, but also I think for the collaboration we have had in the last years, actually with the OECD, also in terms of the accession process of Croatia, but also, for all the past interaction. I'm happy also to be here with many of, the members of the board of ESMA with whom I have been interacting when I was a commissioner of CONSOL, but I think my successor, Carlo, is much better than me, so you are in good hands. No, but it's great. Now, I want to be sincere, and for people who knows me, if I tell you I'll be brief, it's like when Jean-Paul is saying this. This is a non-credible. Okay, so actually, I will not be brief. I also asked Natasha, and tomorrow, and actually I have been, if you see the program, incredibly, I have 10 minutes more than Jean-Paul. And also I asked Natasha to be shorter. So I mean, I still have a lot of time, and so Jos, I think I will use it. No, I'll try, but okay, I have been allocated 30 minutes. But it's, again, it's great, and I think this is a great topic, and fits also, I like very much was Matteo was saying in what we are also living today, the discussion, the political discussion. Very interesting, the agreement that Matteo was referring to. I was discussing with Ante before, of the 8 countries. Very important, and very important, happy also to support this process. Now, in terms of the outline of this presentation, which is just, I hope it will be useful for the discussion later. Basically, I will briefly mention something that has been anticipated, some of the challenges that European capital markets are facing, and actually how digitalization may help address them, provided that it is accompanied by sound regulation, I would say supervision as well. And I will draw briefly on the Draghi and Letta report to highlight some of the key considerations related to European digital regulations. And against this background, I will then focus on key priorities that regulators that you should also take into consideration, particularly, maybe interacting with other regulators, particularly concerning AI. So these priorities concern basically 3 fields. Natasha mentioned also financial stability. I would say financial stability, competition and consumer protection, but also you, in this crowd, you interact again with other regulators typically, and also in terms of the ministries, also there is a lot of interaction. Actually, in my directorate at the OECD, I'm dealing also with competition and antitrust, and also broadly consumer protection. And then I will share some main findings of our investigation on current regulatory approaches to AI, and some of you interacted with us. And next, I will focus on how innovation facilitators, some of you mentioned also some of the sandbox experiences, is one of them, between markets and technological developments. And we conclude by also emphasizing, I mean, we are also in the world of, EU regulators and ESMA, so how also, I think supervisory convergence and in convergence and international cooperation may help in this digital age. Okay, so I will start with the observation that quite obvious that capital markets remain underdeveloped, and the main observation here is that there are still significant difficulties in channeling savings into productive investments, so underdeveloped, but also with a lot of divergence across countries. Now, this chart shows that the EU has been characterized by a high level of savings, basically compared to the size of its economy since the early 2000s. And the EU savings rate today is still significantly higher than those of Japan, UK, and US. And so in theory, this is a precondition. Well-functioning capital markets should then channel these savings into the most productive uses, so fostering innovation and growth. So, and that's why I think it was a good idea to rename, Capital Markets Union. Matteo, you were mentioning, there was not also the political appetite top-down. If you talk about Capital Markets Union to top-down, prime ministers, they really don't understand. They don't see the political appetite. Savings and investments union, having demand and supply put together, the value for citizens, taxpayer, to participate in the markets, I think has been a good idea. Now, the thing is that, again, European capital markets are falling short of this, promise to go in productive area. Here, we observe that around 1/3 of households' financial assets are held in cash or deposits. And of course, there is significant cross-country variation. But the overall picture, points to difficulties of European capital markets in mobilizing household savings for productive investments. Obviously, also bonds are an important part of it. Corporate bonds, we work a lot on these. But we had a very good also interaction with IOSCO, thanks to Jean-Paul in our work that we are doing, and many of you also are see Vasiliki, the others in the work of our corporate governance, corporate finance. Now, so the thing is that, and by the way, when also you see equity, remember that in many cases, now Carlo, for example, for Italy, you may be surprised of this high level of equity, but really this is also a lot of, this is the unlisted part, a lot of family firms and others. So this is not really the listed part. So if you see the data also of the ECB is much, much less. So what also, one thing that is important is that there is a lack of equity culture, I would say, not only on both sides, so supply and demand, and the need so to incentivize equity investment. This is not an end in itself. But why we need, developed capital markets? And again, with many of you who have been working on this a lot. These capital markets are important in the history. I like to see, the past teaches a lot for the future. Traditionally, we have seen that with developed capital markets, they have been financing not only the great, ventures, railways, networks, industry, telecommunication, the US history, not only big firms, but also small firms, because small firms are the big firms of tomorrow. But also, again, I was sitting with many of you during COVID times. I mean, you remember, during capital markets are anti-cyclical, counter-cyclical. And actually, luckily, you remember in those days, let's close markets, let's close stock exchanges. Actually, luckily, markets remained open. And we had $7 trillion that were issued during 2020, 2021, half equity, half bonds. So this is very important, counter-cyclicality. But also the third reason is that it is much easier. This is a question of financial democracy. This is much easier for citizens to participate, to invest in their future, the future of their kids, and participate in wealth creation. This is not only for, the super wealth people, for Warren Buffett, but it's for everyone. Okay. Now, the thing is that we have underdeveloped capital markets, all what we have seen. This contrast is sharp not only with respect to the US, but also with Japan and UK. And this is also due to the many reasons, lack of scale of institutional investment base. We estimated on average, domestic institutional investors hold only 6% of domestic market cap in the EU countries. And this is really tiny, when compared to with the US, where domestic institutional investors hold 58% of domestic stock market cap. Obviously, you may say, okay, but this is the size, but that's why we need, more integration. Maybe we got also something wrong in the past in supervising some of the big mega mergers in the EU. Now, the difficulties in channeling limited resources into the most productive investment so ultimately contributed to the disappointing productivity growth rates we observed since the early 2000s. And also in this case, the difference is really striking. This is what we are talking about. So timid economic growth is both, a cause and an effect of insufficient capital market development. So on the one hand, underdeveloped capital markets are not effective in channeling savings into productive investments. On the other hand, market actors are less inclined to invest in an economy with faltering, growth rates. Now, why we are mentioning this? Because digitalization is an important issue, could help really to break this cycle thanks to the increase in efficiency and productivity it's associated typically with. However, digitalization brings also risks. So because of of this, it's important for policymakers, for regulators, for supervisors to craft regulation and supervision that allow digital innovation to flourish, responsibly, sustainable manner, aiming for a balance between risks and opportunities. Now, both Draghi and Letta reports stress the importance of sound tech regulations. They did not focus actually on how to regulate digitalization specifically, digitalization to benefit financial markets. However, I think the general analysis they conducted can inform our discussion today and serve as a useful also basis for some of the thoughts that we are having. Letta report, I think there are two interesting reports. The EU likes actually former Italian prime ministers to write reports, and so we will see if there will be others. Now, it argues that EU digital regulations have prevented the potential fragmentation that could have resulted from the introduction of national rules. And however, this is not sufficient. The report argues that the current regulatory model relies too much on loose, I'm quoting, loose cooperation among national regulators. So thus there is a need for a strong EU regulatory, supervisory authority which is responsible for guaranteeing the coherence of rules across the single market. Furthermore, Draghi report emphasizes that EU tech sector is still characterized by significant regulatory barriers that affect the ability to scale up, especially for young companies. The report argues that these barriers are a drag on growth, and often only larger companies have enough capacity to bear the costs of complying with them. So overall, both reports seem to give the message that regulation should be not only relevant and efficient, but also minimally burdensome. And obviously, striking the right, and I was quoting, striking the right balance obviously is the art that you are very good in doing. So I believe that this consideration applies perfectly when it comes to regulating capital markets in light of digital innovation. Now, let me go to more specifically, closer to the topic of also the panel. So I want to highlight mention three key areas that capital market regulators need to take into consideration to ensure a sustainable interaction between digital innovation and capital markets. And in all these areas, I will bring an example of the impact of AI. So as I mentioned quickly before, they are financial stability, competition, and consumer protection. So let's start with the implication of digital innovation for financial stability. So through the example of the use of AI in finance. And the use of AI in finance is indeed becoming more common, bringing with it benefits and risks. We have been working a lot also with FSB on these. I remember, Jean-Paul, you were there when we had that big day also with the FSB SCAV chair. Now, just to give you some context, nothing, I guess, new for you. Just these are OECD, the analysis and numbers, and many of you actually interacted and gave us the numbers to input. So financial markets regulators reported recently that various financial market sector participants currently experiment with, develop and or deploy AI tools. And this is commonly more for the case for banks, insurance companies, and asset managers. Regulators observed the use of AI for the provision of financial products and services. According to our survey, the most common products are those related actually to banking and payments. Most regulators also cited the use of AI for credit underwriting. And in fact, AI-based models can support creditworthiness assessments for companies with limited credit history and or collateral, with less bias, but I will mention then something later. Other uses include financial advice, insurance underwriting, and trading. Less. As just mentioned, the widespread use of AI in financial markets creates, we always say, both opportunities and risks. in terms of benefits, I mean, nothing new, but again, I have just to introduce the panel, so my task was easier than the discussion later. Now, in terms of benefits, AI can enhance operational efficiency. For example, it can automate risk modeling and fraud detection. It can also improve fraud prevention by reducing false alerts and strengthening anti-money laundering checks. These can help to save time and reduce costs for financial market participants, such as banks and insurers. AI, second point, is also interesting, important, and being used in smarter asset management. It can assist with investment decisions by analyzing data and risks more efficiently, and support activities like trading, portfolio planning, and risk management. Third, in addition, AI can also improve customer service, and actually is widely used in that. It enables faster, more cost-effective, and personalized support, and can also contribute to internal tasks, such as translating and summarizing content or generating codes to streamline processes. At the same time, there are important risks to consider, put it very, very simply again, just for the purpose of the panel. One major concern is the reliability of the data and models that underpin AI systems. Now, this is a big issue. Poor quality or biased data can lead to inaccurate or unfair outcomes, particularly when these tools are used in decisions that affect consumers or financial markets broadly. Moreover, as AI models become more complex and widely adopted, that may introduce new forms of interconnectedness and between firms. And this could make it, all the MBFI debate, this could make it more difficult sometimes to identify emerging risks and vulnerabilities in the system, especially if models behave unexpectedly or are not really understood by users. I mean, again, is the debate we had on macro-stability after the crisis. But also third-party dependency is also a risk worth mentioning. The failure of a third-party service provider on which too many financial actors rely could cause widespread financial instability. Maybe sometimes we should also be careful in regulating, starting to regulate suddenly, especially in the EU, oligopolies or monopolies, because then you really strengthen the incumbent rather than increase competition. And so let's go to competition. So, an implication of AI for competition policies. I mean, it's needless to say that competition is essential for capital markets to deliver on innovation and ensure that its benefits really reach consumers. In general, AI can contribute to healthy competition by increasing productivity and innovation. For example, AI can make online search markets more competitive by, enhancing smaller players. It can also help consumers navigate markets more efficiently by reducing search costs and mitigate their bias. So it's too early to give a definitive view on how AI will influence economic competition. However, our work already highlighted several emerging challenges that regulators should pay particular attention to. And again, both regulators in terms of financial markets, you, but also your colleagues in Competition Commission. First of all, disparities in data access. Again, data is central here. The limited access or partial access can really distort competition and, as usual, entrench the incumbent, so the dominant position of incumbent firms. This is because data access is central in developing and training AI, is the precondition again. This is the case for large proprietary databases, which firms can leverage to gain an advantage over competitors. Moreover, data transparency for existing AI models is still generally low. Second point can be made, it's quite similar, about computing power. Access to compute is important at all levels of the AI value chain. However, only relatively few firms may afford to pay the high cost of computing power. Not talking about the energy used, but okay. This can be an important barrier to entry that can further advantage the incumbents. Okay. Also, competition concerns may be amplified by firm conduct, by the conduct of firms. So acquisitions, for instance, may decrease competition, obviously, by lowering the number of competitors. One of the most damaging examples is the so-called killer acquisitions. You simply, the only intention in some cases is to acquire a competitor and basically kill its product before it emerges. And partnerships also across firms can also bring risks when, for example, they give exclusive, again, access to data. And lastly, the fact that several firms operate at different levels of the AI value chain may lead to some firms obtaining significant market power and foreclosing rivals. So this can happen when significant, exchanges, I wrote a lot about it. There are a lot of network effects, obviously, on these, and when there are also economies of scale. So these can really lead also to the integration of AI across different layers, such as cloud services and digital ecosystems. So these points in general raise general concerns about the so-called winner takes all. It's not the ABBA thing, but it's really what happens in terms of competition dynamics. So hurting the quality and affordability of goods and services. So however, it's important to note that excessive regulation and supervision could stifle innovation. So it's important to find a good balance. Let me see in terms of my balance. Okay, it's not going bad. The third area, but I will try to accelerate, is consumer protection. Also in this case, I'm going to focus on the example of AI. The prime example of how AI can promote financial inclusion is creditworthiness assessment, I mentioned quickly before. AI models, we have been working on these, can support fairness by reducing personal prejudice in lending decisions. More specifically, alternative data and advanced algorithms could help consumers who previously could not access credit markets, so were rejected loans. And there are already positive signs. But there is always a but. There are challenges in this field. For example, generative AI systems may produce misleading or incorrect information. There is also risks really linked to basically data privacy and the potential misuse of personal information. But also AI in this field actually could lead to the opposite bias, because basically there could be bias and discrimination bias, for example, or on ethnicity and gender. So it depends on how you input then in the system in order then to have data running. And this could be unintentional due to interferences made possible by AI, but it also could be intentional. AI could also exacerbate socioeconomic disparities by supporting more accurate price discrimination. And how can regulation address these? Okay, obviously I'm selling my carpet here. Transparency and explainability requirements are essential but insufficient, so we need global standards. Some of you mentioned the global standards. In our case, we have the G20 OECD high-level principles of financial consumer protection. It can help promote consumer protection in a digital world, including in AI-driven finance. These principles, actually, many of you are familiar, set out the foundation of an effective and comprehensive framework for financial consumer protection. They are recent. They were endorsed, the new edition in the G20 Indonesia, 2022. So they are not only OECD, but also all the G20 non-OECD countries are there. So the impact, opportunities, and risks of technology advancement are relevant to their implementation, and this includes, among many other things, how consumers interact with digital financial products and services. Actually, again, we updated in 22. We have been working also with some of you on this issue, doing assessment on how authorities like you basically implement and work in terms of financial consumer protection. We have a good discussion, Jean-Paul, thanks to you. We have a big session at the IOSCO annual meeting on these issues. And actually, I mentioned there, Derville, our former colleague, now she's in the new money laundering authority, but we did with the Central Bank of Ireland a full assessment on how they implement the consumer protection, and so the principles, and this was also the basis for Central Bank of Ireland one of the inputs for the reorganization of the bank. As you may probably be familiar, this is a single regulator within the central bank, and so we are happy to do this exercise with you. This is important because this is also, and again, this was a discussion we had in the IOSCO meeting on investor education and literacy. Basically, we have done, I mean, obviously we have to start like in school, so we need financial, education and then working with, for new retail investors. And why? Because this is very much influenced by, this new digital world. New data, we worked a lot with AMF, Marianne is not here today. We did this research, which is impressive. After COVID, basically 10% of adult population in France entered financial markets. The majority of these are people under 35 years old, okay? And they have a strong preference for crypto assets. Per se, there is nothing bad, per se. They use online intermediaries and channels to make a transaction. They listen only to influencers. They don't care of PowerPoints and advice of financial regulators unless you try to speak with the same means, so the same that they typically use. The youngest tend to look, again, for information through these informal sources. At the same time, actually, okay, I will be quick, but actually many of them think that there is deposit insurance on crypto assets. I mean, information are completely biased, and they cannot really rely on their parents, because we know, I have 3 kids, we know less probably than them. So I think this is an important issue, and so the work on financial literacy is not a cost, it's an investment, and again, also we are always happy to work on this. Now, quickly, how approaching and also in the OECD countries, this AI. We have done recently this report which covers 49 OECD and non-OECD jurisdictions. We had a session at the G20 in South Africa, finance ministers, central bank governors, so AI in finance on this. Now, the thing is that in general, maybe there are different approaches to that. On the one side, typically saying financial regulation should be, in a sense, tech neutral, and so this means that it remains applicable regardless the technology markets will use. That's why most of the jurisdictions have regulation that applies to use of AI in finance. However, in addition to existing regulation, most jurisdictions have introduced some forms of policy that covers specifically AI in finance. And, okay, the majority introduced or is in the process of introducing, like in the EU for the EU AI Act. More than a dozen jurisdictions have non-binding policy guidance, while only a minority do not have an AI framework. And again, but these are non-mutually exclusive. They can be complementary. Now, non-binding policy guidance shows the most common examples are supervisory expectations or positions, which in part also is what you are white papers and others. Again, I'm a bit accelerating. When looking at regulatory gaps, we found that most jurisdictions did not identify any, is on the left. Most jurisdictions do not plan to introduce new regulation for AI finance soon, which is the right. However, constant and rapid evolution of AI technologies requires the regulator to constantly monitor of gaps. Some priorities, and I about not to conclude, about to start, develop my conclusion. There is a need to better assess whether AI deployment can be made safer by expanding the existing rules covering AI in finance. So this will become even more urgent in the future due to the rapid pace of the technological advancement. And again, also the work that you're doing at ESMA, the work also the standing committee, Carlo and the others. Second, in many cases, it can be helpful to assist entities in their compliance efforts. Third, it's essential to routinely review the effectiveness of existing policy framework. And fourth, it's key to develop sound international cooperation among regulators, supervisors, and the industry. Also, we are playing this part. The OECD, we're building on our findings about regulatory approaches in AI to support financial regulators and supervisors in unleashing the benefits of AI in finance. Actually, we're working with some Asian jurisdictions, but also with Italy, we have a project with, supported by DG Reform, SG Reform now, with Bank of Italy, but also Consob to wider deployment of AI in finance, how to alleviate also the impediments. And this will allow, hopefully, Italian financial markets and participants to capture the productivity gains. And then we have broad projects with many countries in Asia on artificial intelligence and finance in Asia, also with many of them. In general, obviously, rapid technological advancement are creating a constantly evolving and uncertain environment. So we mentioned, but again, I will skip these, basically the innovation facilitators, just to show you, this graph is in the last Asian financial markets report, but this can be interesting capital markets report, which presented few in Tokyo when it was some months ago. And we mapped the innovation facilitator arrangements. You see there are different way of interacting with the market, but I will, obviously the presentation, I guess, will be available to all of you in case you are ever interested. Now, the experiences of these innovation facilitators shed light on their benefits and challenges, which can be also summarized. The benefits are clear. Innovation facilitators publicly signal that authorities are prioritizing and encouraging AI innovation. This can foster the growth of capital markets by accelerating the adoption of AI. This initiative can help financial inclusion. They can benefit participating authorities by incentivizing innovators to engage with regulators. But, again, I cut it short, they carry some risks. Effective innovation facilitators can require significant levels of funding. The use of regulator-level innovation facilitators may be less effective for AI-related innovation with significant cross-industry applicability. Regulatory authorities could suffer reputational damage if an innovation facilitator scheme is associated with business case that may cause some harm to market participants. And so it's important, to select the most appropriate innovation facilitator, ensures diverse technological expertise, and also once chosen need to monitor and also international cooperation, because this is the typical area where you do not have borders. Now, just going to emphasize again, sound capital market regulation in the digital age must be accompanied by supervisory convergence. This is nothing new for you, but again, this is quite essential. Maybe the novelty of this, again, is that it's not only, let's say, IOSCO, it's not only, or ESMA, horizontal convergence across financial regulators. I think you need also horizontal conversion in countries and also across different regulators. And I'm happy also we manage one of the sisters of IOSCO, IOPS, and so Ante actually is a prominent also member there. But it's important that there is also coordination depending on the structure of financial supervision in each country to coordinate even more, because fragmented supervision really ultimately deters international investment. And so there are different systems, and in the EU, different, if you have different 27 legal systems, but actually with different interpretations, we see that that can be. Oh, but I'm concluding. So with basic again, you have regulators and supervisors. You have a lot of on these a lot of challenges. I look forward also to hearing the panel, but also the following panels tomorrow, really to achieve the full potential of the digital, because this is, again, risks and opportunities, but risks should not lead us, and part also of this game, to really to stop regulation, to stop innovation, because you see that there are different, behavior in other countries. Obviously, digital, this adds another layer of complexity and uncertainty. This is also why also you, like us, I remember when I was in Consob, we need also new skills in regulators to do it. We should be careful also to have tech neutrality on these. And these can really help to have then what also Matteo was saying at the beginning. In the end, we need more developed capital markets, integration also with proximity and specificity of local markets. But at the same time, that capital markets are so integrated, probably are more integrated internationally than in the EU. And they, funds can really live very quickly. In the end, EU capital markets is 10% of world market cap, so sorry, is insignificant. So it's important that the EU is having, you know, EU 27 policies, and I think the initiative of Savings and Investments Union is important there. But also, I think, having a look in the international framework. That's why also it's important that Croatia also is finalizing. We are very happy the process is going very well of the accession to the OECD with other 2 EU countries. I think is the third step after Schengen and Euro, and we are cooperating very well with you. So thank you again. It's great to be here, and thank you very much. In the end, I can leave you also some minutes, even if I use something more. Thank you.